you've clearly done okay from premium beer. Tell us where you're seeing the strength in premium beer and why you think you're seeing strength in premium beer right now.
Very good. Thanks. Good morning. Thanks for having me. Across the board, we are very happy with our results. Indeed, volume growth 1.5%, 5% revenue, 8.3% operating profit. That's what we set out to do. We're very happy that we're able to deliver that. Premium indeed continues to be an incredible strength of the company. It's an old trend, but that's still very relevant. Over the last years, premium has outgrown the category time and again. We are the leader globally in premium beer, of course, with the Heineken brand, which was even growing 9%. We keep investing disproportionately in our key premium propositions, Heineken, Moretti, Desperados, Kingfisher Ultra in India, what have you. But indeed, also 0.0, very important, up another 10%. We like to say that we're the pioneer. Back in 2017, when we globally launched the Heineken 0.0 brand, the category was basically dormant, and now it's growing consistently double-digit year over year. Yes. And we really, for sure, intend to keep it up.
Okay, Dolf, I want to ask you about that growth. I mean, how big can that category get as you witness changes in society, perhaps, and Gen Z may be consuming alcohol in a way that's different to older generations? How big does that category grow?
We believe that over time, this really will become a meaningful part of the market. And you already can see, I think globally, it's still barely 1% of global beer. In key Europe, it's already on average around 5%. And in key markets like Spain and the Netherlands, it's already 10%. I saw recent numbers that, for example, in the food channel in the US, it's already 4% of revenue. So it is really scaling. And if we keep this double-digit growth up year over year, we do believe it will become a very significant segment of the total beer market going forward. And again, we are the global market leader. We calculated that since we launched Heineken 0.0, we have captured around 40%, 40, of the total growth of the 0.0 segment globally. And we will keep investing, like what we're doing with the Formula One sponsorship, which is fully dedicated against Heineken 0.0.
Dolf, it's Kriti in London. I want to ask a little bit about your consumer spending story here. In the States, we are seeing a little bit of a slowdown, most recently in earnings like in the likes of McDonald's, for example, which I can appreciate is a very different product offering than yours. But the way that you are seeing some of these American companies deal with it is an increase in prices to offset the increase or the decrease or even the stagnation in volumes. Is that something that you're looking to impose when it comes to maybe offsetting that slowdown in the States?
No. So for us, the States is a relative moderate-sized market. For us, what's really important is our diversified geographical footprint. We're operating in 70 operating companies across 4 regions. We saw growth in all of them in the aggregate, so very pleased to see. On the pricing, for example, in Europe, after a lot of input cost-driven pricing in the last years, we made indeed a deliberate choice to be moderate in our pricing last year to really allow the consumer to catch up. And we did see that with beer returning to growth in our core European markets. So that's at least how we want to go about it. Overall total portfolio, we always aim for balanced growth, meaning both volume growth and having good price mix growth, as we were able to deliver last year.
Well, Dolf, you talk about that diversification story. I'm looking at the volumes number here. Sales coming from Brazil, Mexico, India. Let's talk about another major EM market, and that, of course, is China, where the consumer has been at the core of the concern. What are you seeing there? Are you seeing promise in that part of the world? Is some of the fiscal stimulus coming through from the Chinese government actually showing up in consumption? What does that look like for you?
Yeah, we really focus on the part of the market where the growth is, which is in premium. And we're fully focused on the Heineken brand. The Heineken brand was up double digits again last year in the key Chinese market. We now also see good growth on the Amstel brand. So we really focus on premium in the Chinese market. That's not everywhere the case. In a lot of our larger operating companies, we play both in mainstream as well as premium. And by the way, And this is the first time in a couple of years' time that globally we did see mainstream positive at around 1.7% and premium around 5%. So we feel we're in a good place from that point of view.
Dolf, good morning, it's Guy. Let's talk about inflation. How much inflation do you think the consumer will take? How much of a price maker can you still be in this current environment?
Yeah, I think we need to be balanced. The consumers had to take a lot of pricing over the last years. For example, the energy shock in Europe, in our core European markets, has really led to very fast price growth in the recent past. That's why, again, we deliberately kept our pricing moderate to allow the consumer to catch up. You do look at it market by market. For example, in key African markets where you have hyperinflation, you really need to make sure that you price for the inflation, because otherwise the profitability erodes extremely quickly. So it is market by market. But we are happy with how we were able to navigate that last year, allowing consumers to catch up.
How much input inflation are you anticipating going forward? You've got aluminium and steel tariffs now becoming a reality. That's going to affect, presumably, what happens with the cans. Energy is also something of a crisis here in Europe as well. We're talking about European industry maybe needing to be helped by the European Commission with price caps. How much energy costs inflation are you talking about? How much materials cost inflation are you thinking about as you plan for the rest of this year?
Yeah, we guide on that in our outlook statement. So we're guiding mid-single-digit input cost inflation for this year. But actually, that's driven by some of these high inflation countries in Africa. If you isolate for them, we expect low single-digit input cost inflation, so which is pretty moderate. And that has to do that we're already almost fully hedged for the year, for 2025.
Can I ask you, Dolf, about something that's happening in another sector that many analysts are thinking about how it will affect your sector? I'm thinking here about GLP-1s, that class of drug that helps people to lose weight. And there have been a number of consumer-facing businesses that have made statements about how they expect this to maybe weigh on demand or at least impact, or they're studying it. Are you doing work on what you think the impact of wider use of this kind of medication will be on businesses such as yours?
Yeah, no, it's certainly something that we should follow closely. Right now, it's predominantly a US, North American phenomenon. The correlation between the medicine and food consumption has been more established than it has been on alcohol. So it's premature to draw any major conclusions on it. And in the aggregate, I would worry right now more about keeping our pricing moderate. Worries about consumer sentiment is higher on our list than GLP-1. And again, the strength of our global footprint, having all those big operations across Southeast Asia, India, Africa, Latin America, really makes that, we have a diversified portfolio, also mitigating of any impact that might come forward in the future.
Dolf, a final question on the buybacks piece of the equation. In your earnings announcement, you're talking about a €1.5 billion share buyback program over the next 2 years. And this was widely expected by the analyst community. But talk to us about the sustainability of that at a time when we are dealing with that geopolitical volatility as well. How long can you keep that buyback plan up?
Yeah. No, what's very important, we for many years had a very clear hierarchy of capital allocation priorities. First and foremost, investing in organic growth. And again, we're doing that. We increase our marketing, selling expenses at double the rate of the revenue growth with 300 million increase. Digital technology. Right now, we're building 3 new greenfield breweries in high growth markets in Mexico, Brazil, Dubai. So that's always our first priority. Inorganic opportunities we'll always pursue if they make sense, like what we did in India with the acquisition of UBL or Distel more recently in South Africa. But we are deleveraging very quickly. We generated more than 3 billion in cash flow last year. Our leverage dropped to 2.2, which is now below our optimal capital structure, which gave us the confidence to decide and commit to this share buyback of 1.5 billion over the next 2 years.